All right, let's jump right in. Welcome to this explainer. Today, we're unpacking something pretty fascinating. VAS 04, the accounting standard for intangible assets. Now, I know reading through accounting standards can sometimes feel, well, like you're trying to decode ancient hieroglyphs. But stick with me here, because we're going to take all that dense jargon and turn it into a super clear, easy-to-follow visual roadmap. By the end of this, you're going to see exactly how these rules actually shape the financial reality of modern businesses. But first, just think about this for a second. How do you actually value the invisible? Seriously, how on earth can a business put a real concrete price tag on something you literally cannot touch? We're not talking about your standard trucks or factories or warehouses full of inventory. We're talking about software, patents, land use rights. These things are entirely invisible, right? Yet they're often the main engine driving a modern company's worth. So how do accountants capture that magic without just, pulling numbers out of thin air? So here's our roadmap for today. We're going to walk chronologically through the whole life of an intangible asset. We'll hit what they are, the four recognition criteria, determining initial cost, the R&D phase, depreciation, and finally, disposal and reporting. Which brings us right to Section 1. What is an intangible asset? Let's start at square one. Before we can slap anything on a balance sheet, we have to see what actually qualifies under the VAS 04 rules. The standard gives us a really specific definition. Yes, it's a non-physical resource, but it absolutely must be three things: identifiable, completely controlled by the enterprise, and expected to generate future economic benefits. So even though it's invisible, it has to be something you actually control, usually through legal rights, and it has to make you money down the line. Think of a patent, or maybe a franchise license, or a fishing quota. You can't physically hold them, but legally, they're yours, and they definitely bring in revenue. Now, this brings up a really common point of confusion. What exactly happens when the invisible thing is permanently stuck inside a physical thing? Well, VAS 04 has a pretty elegant rule for this. You just look at which element is more important. For example, if you buy a computer and it has an integrated operating system, like the machine literally won't turn on without it, then that software is just treated as part of the hardware. It's a tangible asset. But if you go out and buy standalone software that you can install or remove whenever you want, the physical disk or drive is totally secondary to the code itself. So in that case, it's classified as an intangible asset. All right, now that we know what it is in theory, let's move to Section 2, the four recognition criteria. I want you to think of these four steps like a ridiculously strict bouncer at a VIP club. To get on the financial statements, an asset has to clear all four checks. First, it absolutely must bring certain future economic benefits. Second, its cost has to be reliably measured. Third, the useful life got to be greater than 1 year. And fourth, it must meet the standard for value. If an asset misses even a single one of these, like let's say you know for a fact it's super valuable, but you just cannot reliably pin down its cost, it does not get past the velvet rope. No recognition as an intangible asset. It just gets expensed immediately. So assuming your asset passes that VIP test, we enter Section 3, determining initial cost. Let's talk about pricing the invisible. How do you figure out the initial price tag, or what accountants call the original cost? Well, it really depends on how you got it. If you bought it separately, it's easy. You take the purchase price, tack on any non-refundable taxes, and add whatever direct costs you incurred getting it ready to use. If you got it through an exchange, you generally measure it at fair value. But here's a really interesting quirk regarding land use rights. If you buy land use rights along with a physical building sitting right on top of it, VAS 04 says, nope, you have to separate those. The building is a tangible asset, but the right to use the land itself, that's carved out and treated entirely as an intangible asset. Now let's tackle a much trickier scenario. Section 4, the research and development phase. This is all about internal asset creation. And man, this is where businesses make some huge accounting mistakes. To get this right, you really have to understand the showdown between research and development. The standard draws a hard line between these two phases. Research, that's all about seeking new knowledge, exploring, brainstorming alternatives. Because it's so incredibly uncertain, research costs are always written off as an expense right away. You just can't capitalize them. Development, on the other hand, is when you take that knowledge and actually apply it to a specific design or product before going to commercial production. Because you're much closer to having a real working product, development costs can potentially be recognized as an asset. Notice I said they can be recognized, not that they automatically are. It's a huge distinction.
To actually capitalize development costs, you have to check off 7 highly specific conditions. You've got to prove technical feasibility, your clear intention to complete it, your actual ability to use or sell it, that it'll definitely generate future economic benefits, that you have the technical and financial resources to actually finish the job, and that you can reliably measure the costs. Basically, it's an incredibly high bar, and it's designed specifically to stop companies from inflating their balance sheets with a bunch of failed science experiments. And while we're talking about internally generated stuff, we absolutely have to mention this rule. Internally generated goodwill, brand names, publishing titles, customer lists, these are flat out not recognized as intangible assets. Why? Well, because you just can't reliably measure what it costs to create them, and you don't really have distinct legal control over them the way you would with, say, a patent. So any money you're spending trying to build up your company's brand organically, that's just an everyday business expense.
All right, so you've successfully recognized your asset and nailed down its cost. That brings us to Section 5, Depreciation of Intangible Assets. Think of this as aging gracefully. Just like a physical machine rusts and eventually breaks down, invisible assets lose value over time as their economic benefits get used up. We record that as depreciation. And I really want to hammer this number home, 20. Under VAS 04, the standard sets the maximum useful life for depreciating an intangible asset at generally 20 years. Now, sure, there are some extremely rare exceptions if you have rock-solid proof it'll last longer, but for the vast majority of cases, the clock is ticking and 20 years is your ceiling. To track this loss in value, a business has to pick one of 3 methods: straight-line depreciation, declining balance, or the units of production method. And no, you can't just pick the one that makes your quarterly profits look the best. You actually have to choose the method that most accurately reflects how you're consuming the asset's economic benefits. For example, if the asset just strains value evenly over its life, straight line is going to be your answer. Here's a really fascinating quirk that shows the stark difference between the tangible and intangible worlds. Think about a delivery truck. Even at the very end of its life, when it barely runs, you can still sell it for scrap metal, right? It has a residual value. But an intangible asset, its estimated residual value is almost always assumed to be exactly 0. I mean, you can't exactly sell an expired patent for scrap. The only time this isn't true is if a third party legally promised to buy it from you at the end, or if there's an active, ongoing market to price it out. Otherwise, that value drops to absolute 0. Eventually, every journey ends. The asset's useful life expires, which brings us to our final stop, Section 6, Disposal and Reporting. It's time to say goodbye. The standard is extremely clear on when an intangible asset gets derecognized, which is honestly just a fancy accounting term for completely wiping it off the balance sheet. You do this when the asset is disposed of, when you sell it off to someone else, or when it just can't generate any more future economic benefits. The second it stops being a wealth creation tool for your business, it is off the books. But when you do remove it, there's usually a financial gap between what you sold it for and whatever its remaining book value was. That difference, whether you made a gain or took a loss, doesn't just vanish into thin air. It is immediately recognized in that current period's income statement, so it directly hits your bottom line for that reporting period. Getting it off the books isn't the final step, though. VAS 04 demands absolute transparency in your financial statements. Businesses have to disclose exactly how they handled these invisible assets. They need to lay out the original cost, the accumulated depreciation, the specific depreciation methods they used, and this is a big one, they have to fully explain their research and development expenses. This just ensures that investors aren't left entirely in the dark about how the company is investing in its future knowledge. Which brings us to the end of our explainer. We've taken a concept that is literally invisible and given it a very structured, concrete financial reality. So I want to leave you with a thought to chew on. Look at the operations around you right now. What invisible assets are hiding in your own company? Now that you know the rigorous rules of VAS 04, do you see unrecorded research? Or maybe development projects that are actually ready to step up and become true recognized assets? The real wealth of modern business is often completely invisible. You just have to know exactly how to measure it. Thanks for tuning in.